In this lecture, I'd like to introduce cash and statements of cash flows. You remember that I showed you this somewhat sketchy diagram, and the diagram talked about cash flows from investments, cash flows from operations, and cash flows from financing that change the cash balance from the beginning of the year to the cash balance at the end of the year. Now what I'd like to do is to go into an actual company. The company that I'd like to look at is Alibaba Group. Alibaba is the largest online and mobile commerce company in the world, and it has US dollars 5.5 billion annual revenue and about 1.3 billion annual net income after tax. As you remember from the diagram, operating cash flow is different from operating income, and it's different from operating income because of accruals and because of the change in the working capital requirement. You'll remember that the working capital requirement is non-cash current assets minus non-debt current liabilities. So going to Alibaba, this is the consolidated statement of cash flows. Net income for Alibaba in 2013 was 8.6 billion renminbi, yet the cash flow from operations was a much larger 14.47 billion renminbi. Let's look at a few of the items that caused this difference. One item is this: share-based compensation expense. This compensation expense was recognized as part of payroll and payment to outside consultants, so it was a period expense, but it wasn't paid with cash, it was paid with shares of the company. So these were expenses that did not result in a period expenditure of cash, but clearly they were the giving of value. Let's look down at two other large items. We have receivables. These are escrow receivables and loan receivables, and then following that we have some prepayments. So these are prepayments by Alibaba to its suppliers, and these are increases in short-term assets, and so of course they result in a reduction of cash flow from operations. But net working capital requirement also includes non-debt payables, and as you can see there are two large increases in non-debt payables. This is accrued expenses, accounts payable, and other liabilities, and merchants' deposits. So these are deposits of merchants that are customers of Alibaba. And as you can see, these two items in total far exceed the increase in short-term non-cash assets. The net effect is that the net cash provided by operating activities is considerably larger than the net income of Alibaba. In addition to net operating cash flow, there are two other major contributors to the change in cash, and one is investment and the other is financing. Turning first to investment, these are the cash flows from investing activities. The investing activities of Alibaba in 2013, which was largely acquisition of land use rights and other property, plant, and equipment, these two items of cash outflow were financed largely from decreases in short-term investments. So the investing activities were actually self-financing with a little bit of cash left over. Turning to the third area, cash flows from financing activities. In 2013, there was a tremendous amount of activity in financing activities. In fact, there was a major restructuring of Alibaba from a capital structure point of view. There was issuance of equity shares, there was repurchase of ordinary shares, there was issuance of convertible shares, there was repurchase of the equity of Alibaba.com, and there was considerable activity in bank borrowings. But the net effect was relatively small. Cash flow from financing activities of negative 1.4 billion renminbi. So the total cash flow to Alibaba for the entire period was 13.5 billion renminbi. You add that to the cash at the beginning of the period to get a total cash balance, a cash stock at the end of 2013 of 30.396 billion renminbi. Turning to Alibaba's managerial balance sheet, three things are striking, especially if you look at the common-sized balance sheet. The common-sized balance sheet is simply taking the managerial balance sheet and dividing each item by total assets. This gives you, for each item, a percentage of total assets and allows comparison across years and between different companies. Three things are striking. First of all, the rearrangement of financing from 2012 to 2013. You can see that equity drops from 96% of financing down to 38%, short-term debt increases, and long-term debt comes from 0 to 50%. Secondly, working capital requirement is negative. The financing of Alibaba's operating activities, where non-debt payables exceed non-cash receivables and inventories, is a part of the company's model, and it's relatively permanent and increasing. And thirdly, Alibaba has very large cash balances. It has 32.686 billion renminbi, or over 5 billion US dollars. Clearly that 32 billion renminbi is not a single checking account. It's in dozens of different checking accounts and savings accounts in many different currencies in different locations in China and throughout the entire world. It includes time deposits and may even include other money market investments. Cash may or may not be readily available from one account in one country to another currency. The corporate treasurer has to worry about whether he or she has enough cash. She has to worry about whether that cash is in the right account at the right time to effect payment. The need for cash increases with the volatility of operating cash flows and investment opportunities. The bank may allow you to draw lines of credit, and that increases a company's liquidity. A line of credit would be as good as cash if the bank would always lend you money whenever you want it. If the bank is 100% creditworthy, so when the bank wants to lend you money, the bank has the money to lend you and will lend you the money, and if the cost of borrowing is sufficiently low. But such lines of credit are actually quite rare, so holding cash is essential for firm survival, but it's expensive. An amazing 73% of Alibaba's managerial balance sheet assets are in cash, although that 73% is partly a function of the way that we've treated net working capital requirement. Even if we treat that net working capital requirement differently, say that the merchants are really part of the investors, and that 8.4 billion renminbi should really be counted as investment, not as a negative part of working capital requirement, we still find that 61% of the balance sheet is in cash. For Toyota Motor Corporation, the number was 11 to 12% of its managerial balance sheet in cash. Does that make Alibaba better than Toyota Motor Corporation? Not really. A company with a big pile of cash without a comparative advantage in making short-term liquid investments is not maximizing investor returns.